investor friends, I'm Michelle Markey and welcome to my channel. Whether you've been here before or you're new, you know what to do, so don't delay and please be sure to hit that like and subscribe button today because it kind of feels like we're in an economic twilight zone in the early dog days of summer, and that's an actual thing. I just looked it up because if the US economy is like a poker game, then the Federal Reserve and economists are tipping their hand in penciling in a recession for early 2023. So I'll catch us up on the latest recession signs and technical indicators that could be suggesting a recession is where we're headed, if we're not already in one, based on a bunch of recession signs that have been gaining steam, such as how copper prices have been plunging and oil prices have been declining after recently peaking, as well as mortgage rates fell significantly recently after also peaking at 5.8% recently at the end of June 2022. So across all these signs and more, I'll talk about why this is so weird and confusing. And as the Wall Street Journal reported, if we're in a recession, it's a very strange one because there's still lots of jobs and wages are going up, and also consumers are still spending fairly strongly. So it's really weird times that we're in, and these signs will help you be prepared in case the worst comes to pass. So I hope you enjoy what I'm talking about today. And while some people could be in denial about the dark clouds looming on the horizon, a recession would be kind of a big deal because if we have weakening economic growth or straight up economic decline, plus high inflation, that could lead to depressed asset values for a while, like our stock portfolios remaining down for a long time. And it's better to be knowledgeable so that you can be prepared and not be blindsided by what could be coming, because people like the CEO of JP Morgan Chase named Jamie Dimon are warning that people only have another 6 to 9 months worth of spending left, and then an economic hurricane could be coming if you watch my latest video before this one. And it helps if you can know what's going on and also not be scared, because when you don't know what's happening, then that could lead to panic selling, and you don't want that. So the more you know, the better off you'll be. And just to clarify terms, because sometimes people conflate and confuse economic terms together, so I'll define a recession and a bear market respectively, where according to the National Bureau of Economic Research, a recession is defined as a significant decline in economic activity across an entire economy for more than a few months. And we last saw this during the pandemic recession that happened from March through May 2020. And this differs from the previous definition of a recession, where we would have 2 quarters in a row of economic decline to quantify a recession, but that has changed. But we could still be seeing a recession, since if we go by the old definition, the US economy, according to gross domestic product or GDP, contracted by 1.6% in the first quarter of 2022. So in a few weeks, we might see if the second quarter of 2022 also contracted, and that would meet the previous recession definition. And this is different from a bear market that usually has to do with stocks or other kinds of assets, where in the stock market, if we see a broad index decline of at least 20% or more for at least 2 months, then that's a bear market. So a recession and bear market could be happening at the same time, but they don't always, but usually they do. And you might be surprised to learn that the real rate of inflation is actually a debatable figure, because the US government uses various calculations to determine their projections. So the kind of inflation that the media cites the most is known as Consumer Price Index inflation, or CPI inflation, which recently hit a high of 8.6% in May 2022. And while we don't know the figures for June or July yet, I'm sure we'll find out soon enough. And interestingly, if we use some older government calculations, then the figure of inflation could actually be higher, because according to shadowstats.com, it could be as high as 15 to 16% of inflation that we're actually experiencing. And we may have seen some of this play out in terms of rent and housing costs over the last few years, as well as our food that have increased by double-digit amounts. So inflation could be way higher than the government is actually letting on. But either way, the Fed has finally come around onto combating high inflation, since they've been increasingly hiking the Fed funds rate, which is the rate that commercial banks charge each other for overnight lending. And that basically sets the floor for interest rates in the US economy. And then the prime rate is what we all get charged as consumers, whether it's for mortgages or credit cards or other kinds of loans that we might be going for. And the prime rate is usually about 3% above the Fed funds rate. And so the Fed has been hiking this somewhat aggressively this year because they finally realized that inflation wasn't transitory and it was here to stay for a while. So we're dealing with some maybe stagflationary effects, which means that unemployment could be on the rise to accompany high inflation soon enough. And so what we are looking at, the Fed funds rate, the Fed hiked it in March 2022 by 25 basis points and then 50 basis points in May 2022. And recently, as of their June 15 meeting, they hiked it by 75 basis points. So across all those hikes, we're now in the Fed's target range of 1.5 to 1.75%. But the interesting thing is that the Fed funds rate hasn't actually hit into that range yet. So it's a little bit behind, where right now it's at about 1.21%. So we can see that prime rates for mortgages and other loans have crept up way higher than the average 3% above this rate of 1.2%, where some things could still be at about 4.5 to 4.75% if you have lower mortgage terms, like maybe only 5 to 7 years. But for the most part, if you're looking at more than 15 to 20 years, like something like 30-year mortgage rates, you're definitely looking at the 5% and above range, where it had hit like even as high as 7% in some states if you don't have as good credit. But lately it's been coming down. So like I mentioned before, mortgage rates have been declining significantly, where this week it went down to 5.3% after hitting that high of 5.8% at the end of June. And so that is suggesting that the economy could be cooling down, because previously in 2018 was the last time we saw mortgage rates at almost 5%. And then the Fed realized that interest rates could be a little bit high, so they brought them down in 2019. And as soon as the Fed realized that they needed to hike rates, mortgage rates had been skyrocketing for the greater part of 2022 until lately. So we'll have to see if mortgage rates hold on here or if they're going to continue going down. But that could be one major sign to show that consumers are not able to spend as strongly as before. And even though the stock market has been rising after every Fed funds rate hike, the general trend is that the stock market has been declining in anticipation that Fed funds interest rate hikes will depress lending, and then that also has downstream effects to corporations that use cheap debt to fund some growth initiatives. So if debt isn't as cheap anymore, then corporations might be pulling back, and then companies might not be performing as well financially, and then that could lead some analysts to downgrading some companies' buy ratings. So that in general has been probably causing the stock market to go down overall in 2022 so far. And if we look at a chart of the S&P 500, we can see that every time the Fed has raised interest rates, it looked like the stock market was going up thereafter. But a week before the rate hike actually happened, the stock market generally tended to go down some. So this happened in March and May, and also there was even a bigger decline before the June 15 meeting. So I'm guessing that leading up to the next Fed meeting at the end of July, that in the second or third week of July, the stock market will probably go down some more again before kind of leveling off and going up again. But all of this I consider to be a bunch of dead cat bounces, because if Jamie Dimon and other people like Michael Burry are correct, there could be way worse things coming along that we may not even know about yet. So we're in the early days of debt not being cheap anymore, and there's only a matter of time before the tide goes out and we'll see which corporations are swimming naked, and we'll see really if there's a reckoning later on, because right now it just sort of feels like things are okay, but we're not really sure if a hurricane is going to come on shore or not, or if it will stay out in the ocean. So we'll just have to keep tabs on what's going on. And it looks like the Fed is expected to hike the Fed funds rate through March 2023 to reach a final target range of 3.5 to 3.75% as of today's date, based on the CME Group's economic projections of what the Fed might do, because they have this Fed Watch tool where they gather a bunch of economic data from the Fed, and then they use that to kind of guesstimate where the Fed funds rate will be. And the only reason that the Fed might reverse course by May 2023 could be if a severe recession is underway, and that causes them to lower the Fed funds rate, and then maybe that will help to stimulate economic growth if the Fed funds rate is lowered again, so that corporations and consumers can have lower borrowing rates to kind of get some spending going again. But for now, the Fed has to pump the brakes on the economy since inflation is so high. So the Fed is sort of stuck between a rock and a hard place in having the need to raise interest rates and having to combat inflation, but well knowing that it could hurt the economy and consumers overall. And finally, I'll show you how the Fed is tipping their hand in projecting a recession by 2023 in some of their own projections that they share with the public. And so in the following chart, don't get freaked out because I'm going to explain each of these, but you can see all of their projections across maximum employment and their preferred inflation indicator of personal consumption, expenditure inflation, and also their Fed funds rate projections that they have through 2024 and beyond. And I compared their projections from their December 2020 projections with their June 2022 projections. So you can see that their older projections are in a lighter colored line, and their newest projections are in the darker colored lines, respectively, for each of these three indicators. And so we can see with employment, we already exceeded the Fed's goal of maximum employment in the range of 4.5%, where we already hit 3.7% as of 2022, but it's only going to get worse from here. So that's already a sign that starting in 2023, we're going to have more unemployment. So that's not a good sign for the economy, as well as the Fed was totally off on their projections for inflation back in 2020, where they thought that it would go back to 2%, which is their target inflation rate. But they were so wrong because they acknowledged that as of 2022, inflation was around 5.2% at least, and it's probably higher than that, but that's the rate they're willing to target as of 2022. And for 2023, just as they're bringing down inflation, that's also where the Fed funds rate will reach their peak of 3.8% in 2023, which is way above what they would have thought it would have been back in 2020. So just as we're peaking in the Fed funds rate, by 2024, we're starting to decline in the Fed funds rate. So all of these factors are pointing to the fact that we're going to be in an economic slump at the very least, and if not in a mild to severe recession by these points in time. So that's how I'm basically guessing that the Fed is thinking that we're headed for a recession if we're not already in one. And so, yeah, I'm taking these recession signs and other recession indicators I've talked about in previous videos pretty seriously, and I'm trying to get as ready as I can for what could be happening. And what do you think about these recession signs? Let me know in the comments what your thoughts are about if we might have a legit recession on the horizon. And also, in order to be ready, I made this checklist for how to be prepared for a recession, and you can feel free to check out that video too if you think it will help you. And also, if you enjoyed this video or learned something, please like and subscribe. And I wish you well on not only getting through this recession, but making it out on the other side and able to thrive in your own portfolio. So till next time.